Joining us now is the president of Hedge Fund Research. That's Ken Heinz. And Ken, looking at these numbers, we've seen a very strong year-to-date performance, and now it looks like hedge funds taking a bit of a pause in terms of the strength that we've seen thus far this year.
Absolutely, Julie. After 7 consecutive months of gains since February, we saw a very narrow decline in October, just about 5 basis points. That brings the full year performance to just under 17% for the year. There was a mixture of different performances across the different types of strategies. The areas of decline were macro funds and equity hedge funds, declining about 0.75% and 0.5% respectively. And then 3 areas that did show gains and continued to build on strong year-to-date gains were emerging markets funds, relative value funds, and event-driven funds. And
what are you hearing from folks in terms of maybe a little bit about a future direction here? Emerging markets, for example, which, as you say, up about 1.5%.
Yeah, those have done very well for the year. They're up about 35% for the year. Our funds that focus on emerging markets. So that's obviously been an area of strength. That obviously also following a very significant, one of the worst years in history for emerging markets funds, and the single worst year in history for the hedge fund industry, 2008, a year in which the average fund declined by 19%. But I think in answer to your question, what's interesting is that in the third quarter, the industry experienced the first net inflow of capital that it had seen in 4 quarters since the middle of 2008. The inflow was only about $1.1 billion, but it was a net inflow, and there was also a kind of a significant gross flow, because we actually saw $38 billion of new capital go in. At the same time, $37 billion of capital went out of the industry in the third quarter.
So do you think that this represents a significant improvement in sentiment, in confidence in the hedge fund industry, maybe coming back?
We like to say it's recovering, but I don't think it's yet recovered. 2/3 of all funds saw inflows in the third quarter, but on the other hand, to answer one of the questions that we talked about before, and sort of how does this measure up versus what we expected to see, the inflow actually would have been larger, but there were some, in the third quarter, there were some large funds that actually either closed or saw significant amounts of capital come out, so that offset it at the very high end of the market capitalization. Funds greater than $5 billion under management. There was a couple of closures, and a couple of them saw significant capital outflow. So in answer to that question, we saw a net outflow in the larger funds, the $5 billion and up, and actually saw investors allocating to smaller funds. And again, that outflow at the top end of the spectrum was a combination of inflows to some funds, outflows to others.
Ken, might I ask quickly, relative value hedge funds, they were the best performers. Why?
Another strong month for them, and again, that's an example certainly of the reversal of 2009 versus 2008. Relative value was very out of favor at the end of the year, particularly convert arb strategies. These are up over 50% on average. The index is up over 50% for the year, so it's really been an amazing turn. The main driver of that really is credit spreads, and across the board, both in convertibles, in corporate bonds, in asset-backed, in all of those areas, you continue to see really strong appreciation, and that's what was continuing to drive gains broadly across the arbitrage strategies.
Ken Heinz of Hedge Fund Research Inc. joining us from Chicago. Ken, as always, thanks so much.